Here is a number that stops you scrolling. Samsung's operating profit in its second quarter jumped about 18 times from a year earlier, powered by the boom in high-bandwidth memory, the specialized chips that feed AI accelerators. 18 times. Your instinct is to read that as a whole new era, a step change in the business. But that instinct is wrong, and seeing why is the single most useful thing you can learn about memory stocks. The company did not sell 18 times more chips. Its revenue did not multiply by 18. What multiplied by 18 was profit. And that gap between a modest move in the top line and an enormous move in the bottom name. It is called operating leverage. It is the oldest, most powerful force in this industry, and it explains both why memory profits explode in a boom and why they collapse in a bust. So before you decide an 18 times jump means the stock is cheap or expensive, let's audit what that number actually is. Start with the mechanism, because once you see it, you can never unsee it. Picture a small bar on the left. That is the change in memory revenue, the price of the chips going up as AI demand tightens supply. Now picture the bar on the right, the change in profit, blooming to something 18 times the size of the input. How does a modest input produce a giant output? Two amplifiers. First, memory is a brutally high fixed cost business. Building the factories, the equipment, the depreciation, those costs are largely fixed whether prices are high or low. So once revenue covers them, almost every extra dollar of price drops straight to profit. Second, the mix. High bandwidth memory for AI sells at a large premium to ordinary memory, so a shift toward it lifts the average selling price without a matching rise in cost. Put a moderate price increase on top of a mostly fixed cost base. Add the premium mix, and profit does not rise a little, it blooms. That is the whole 18. It's leverage, not a new business. Now, make the 18 even less mysterious, because part of it is the starting point. A year earlier, memory was in a deep down cycle. Prices were low, and profits were scraped to almost nothing. When you divide this quarter's profit by a number close to zero, the multiple looks explosive. That is not a trick, but it is important. A large multiple off a depressed base is exactly what a cyclical recovery looks like, every single time. Layer on the fixed cost structure. Chip factories want to run near full utilization. Idle capacity is pure loss. So when demand returns, the factories fill up, unit costs fall, and margins expand fast. And this cycle has a genuinely new ingredient: high bandwidth memory for AI, which sells at a premium and is in tight supply. So you have three multipliers stacked: a low base, a fixed cost structure filling up, and a premium mix. Each one is real. Together, they turn a good quarter into an 18 times headline. None of them, though, change the fundamental nature of the business. It is still priced on a cycle. Here is the part the 18 times headline never mentions. Operating leverage is symmetric. The exact same math that turned a modest price increase into an 18-fold profit jump will turn a modest price decrease into a brutal profit collapse. Because the costs are fixed, when prices fall, there is nothing to cushion the bottom line. Profit falls far faster than revenue, and a business that was minting money can swing to a loss in a couple of quarters. And memory has done this over and over for decades. It is one of the most reliably cyclical businesses in the entire economy. Capacity gets added into the boom, supply catches up with demand, prices roll over, and the same leverage that looked like genius on the way up looks like a cliff on the way down. So the 18 is not a promise about the future. It is a reading on where we are in the cycle right now, near the top of a price move with the lever fully extended. The question that matters is not how big the profit is today. Now, the honest other side, because this cycle is not a carbon copy of the past. High bandwidth memory is genuinely different from the commodity memory that drove the old boom-bust swings. It is sold increasingly on longer-term contracts to a small number of large AI customers, rather than dumped onto a spot market. It is much harder to make, so supply cannot flood in overnight the way commodity chips once did, and the makers have been far more disciplined about adding capacity than in past manias. All of that can make this cycle longer and less violent than the ones before it. The price rollover might be gentler or further away than history suggests. So the bull is not wrong that something structural has changed. The mistake would be concluding that the cycle has been repealed. Discipline slips, capacity does get added, and AI demand itself moves in waves. So the honest read is not that leverage no longer cuts both ways. It is that the downslope may be slower this time. The lever is still a lever. So what actually resolves whether this is a durable supercycle or a leverage-driven peak? Not the profit number. 3 things about price. 1. High bandwidth memory contract pricing. As long as the AI buyers keep renewing at firm or rising prices, the premium mix that drives the profit is intact. When those contracts start to soften, the top of the lever is in view. 2. New supply. Watch how much capacity the makers announce and build, because the cure for high memory prices is always high memory prices, which invite the capacity that eventually ends the boom. 3. The boring commodity lines. Ordinary DRAM and NAND prices are the early warning system. When the commodity tiers roll over, the premium tier usually follows within a few quarters. Line those 3 up, and you are reading the cycle directly, instead of being dazzled by a backward-looking profit multiple. The 18 tells you what already happened. The price tells you what happens next. So, back to that 18 times headline. It is real, and it is genuinely impressive. But now you know what it is. It is operating leverage, the oldest force in the memory business, amplifying a moderate price move off a depressed base, sharpened this time by the AI memory premium. The single most useful habit you can build is to translate every giant profit number in a cyclical business into the same question. What is the price doing? And where are we in the cycle? Because the leverage that produced the 18 on the way up is the same leverage waiting on the way down. A supercycle and a peak look identical in a single quarter's profit. The only thing that tells them apart is the direction of the price from here. Audit the price, not the profit. This is educational analysis of public information, not investment advice. Verify every figure yourself before you act on any of it.